What's up, everyone? It's Scotty with MoneyVest. So the week is over. November is in the books officially as of yesterday, and December is getting started with a bang, with markets here pushing higher. Even though the Federal Reserve Chairman Jerome Powell did talk about potentially more rate hikes and too premature for talking about rate cuts. As always, if you enjoyed this video, find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. If you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join, and you do get access to all the members-only videos, Excel spreadsheets, Discord channels, trade alerts, trade ideas. Everything is going to be included with the link down below. If you have any questions, please feel free to reach out, and I'm more than happy to help you. So this right here was the headline. So Federal Chair Jerome Powell calls talk of cutting rates premature and says more hikes could happen. And we know that Jerome Powell has been talking tough for a very long time, and he basically wants to make sure that market expectations are in line with what they have in mind for SEP, Summary of Economic Projections, with respect to interest rates. But as we know, that's not how things work. The market is going to front run the Fed, or at least try to front run the Fed. In other words, they're going to price in 4 or 5 rate cuts going into 2024, even though Jerome Powell and the Federal Reserve has told us that they are not expecting any rate cuts in 2024. Maybe just a little bit. There were actually 4 rate cuts priced in earlier in the previous SEP, and that was cut down to only 2 rate cuts in 2024 after the most recent FOMC meeting. And the next one obviously is going to be this month in less than 3 weeks, and we're going to learn more about what their future forecast looks like with respect to the 4 things: inflation, interest rates, unemployment, and economic growth, which is the GDP as well. So despite a string of positive indicators recently suggesting that prices are indeed coming down, the FOMC plans on, quote, keeping policy restrictive until policymakers are convinced that inflation is heading down solidly back down to 2%. He says, and I quote, "It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease, and we are prepared to tighten policy further if it becomes appropriate to do so." And however, he also noted that policy is well into restrictive territory, and noted the balance of risks between doing too much or doing too little on inflation are close to balanced now moving forward. And having come so far so quickly, the FOMC is moving forward carefully, and as the risks of under and over tightening are becoming more balanced as well. So basically what he's saying is that, look, we have already done so much. We have come to a sufficiently restrictive level now. And now moving forward, a lot of what we do is going to be dependent on how the economy responds with the time lags and how inflation responds after higher interest rates. In other words, another 25 basis points, 50 basis points isn't going to do much to fight inflation, but it's possibly going to do a lot to hurt the economy. So that's the balance of risks that they're talking about. They don't want to over tighten, but they also don't want to under tighten to a point where inflation stays elevated and more stagnant at these higher levels. So in other words, they want to move carefully as the data continues to come in. And as the demand and supply related effects and the pandemic continue to unwind, the uncertainty about the outlook for the economy is usually elevated. Like most forecasters, my colleagues and I anticipate that growth in spending and output will slow over the next year as the effects of the pandemic and the reopening fade, and a restrictive monetary policy weighs on aggregate demand as well. And that's really what the Federal Reserve focuses on, is controlling aggregate demand, right? That's what the main goal is. They're not controlling supply, they're not producing more things, but they're really just controlling the aggregate demand by ways of controlling the interest rates. And as a result, they forecast that consumer spending will start to slow down as interest rates continue to be in that restrictive policy. And of course, the time lags now started to kick in, given how rates have been higher for longer. And it's been well over a year since the Federal Reserve started on this journey of raising interest rates. So Dow Jones here up a little bit over 82 basis points. We have the S&P up over 0.5%, and the NASDAQ here also pushing up 0.5% here on the day. This right here was the heat map. So we did see a little bit of rotation out of tech over to other parts of the market yesterday and earlier this week. But of course, today we are seeing, once again, Meta here, Tesla, Google, Microsoft pulling back a little bit. Amazon, Apple very, very flat. So it's really just the technology sector that is somewhat struggling here over the last couple of days. And there is money and liquidity flowing out of those sectors over to some of the other parts of the market, including industrials, real estate, energy, utilities, materials, financials, even healthcare to some extent. But it's really just the big tech, Max 7, that is now starting to see a little bit of that rollover from their because it performed so well, so they are the ones that are now starting to see some liquidity come out and going over to other sectors. But this right here is going to be the 1 day, 1 week, and 1 month performance. Everything is green except for comm services on a weekly basis, which did decline. That includes your Metas and Googles. But over the last 1 month, of course, all 11 sectors are green, and the markets have had a very strong move to the upside over the last 1 day. Of course, oats, Russell prices, copper, we got the bond prices, gold, and the dollar index all pushing higher, with rough rice, our favorite orange juice, sugar prices, heating oil, and canola, soybean, everything starting to roll over over the last 1 day as well. Bitcoin just a little bit under 39,000, and Ether just over $2,000 at the moment as well. I also want to go over some of these spreadsheet items. So again, if you want to get access to all of this, this is going to be intrinsic values, arranged by alphabetically. It's going to be available with the link down below. I highly encourage you to check that out. You get access to, like I said, the intrinsic values that we have calculated. I've calculated for all these individual stocks, but I really want to go over the bear market, actually the S&P 500 RSI reading at over 73.43 right now. So we are obviously at a very, very rare level, something that we haven't seen in a very long time. And you'll notice that anything that's over 70 has only happened to 10.27% of the times. And we are in the 94th percentile, with this being incredibly rare. So again, it's not a question of if, it's a question of when. Just got to be careful with the risk reward that's set up at the moment. Volatility here, on the other hand, also coming down to 12.63. We are in the under 15 percentile, very, very rare. And the number of times it actually trades below 20 is going to be 61%. So majority of the times, volatility is below 20. And that makes sense because the market's been on a consistent bull market. It's been on a consistent run higher than new all-time highs over the decades. But of course, we are at now very, very low numbers, below the 25th percentile, since we are trading at under 13 right now. This right here is going to be the NASDAQ percentage of stocks trading above their 200 simple moving average. We are at 52% right now. So in other words, more than half of the NASDAQ stocks are now trading back above their 200 simple moving average, and we are in the 61st percentile. And if you take a look at days above 50, it's going to be at 42.5%, right? And this is going back as far as almost 700 observations. So it's a little bit over, I want to say like 30, no, not 30, but 694 divided by 252. We're looking at just a little bit under 3 years worth of data, but we are in the 61 percentile, still normal, but definitely keep in mind where the technicals end up being for this index. Now, this right here is a shorter term technical market technicals and breadth indicator, which is the percentage of stocks trading above or below the 20 simple moving average. And right now this number is at just under 89%. What that means is almost 90% of the stocks in the S&P 500 are trading above their 20 simple moving average, which from a technical perspective does suggest a very, very strong market on a short time frame. And of course, we are seeing the 96th percentile in a very rare occurrence for this index as well, because you'll notice days spent above 80 is only 15%. So we're certainly getting up to those levels. And look, markets can remain overbought longer than you can remain solid, right? So just because the markets are overbought does not necessarily mean that it's time to short the market. We're all here trying to understand the risk and reward, right? It can also be looked at from a perspective of, okay, the markets are overbought, the technicals are extended, so I'm not going long, right? Some people might look at this data and be like, okay, markets are overbought, they're overextended, I'm going short. No, it can be also the other thing, like markets are overbought, they're overextended, I'm not going long, right? So there's both things, right? Just because markets are overbought, like I said, doesn't mean that they're going to see a pullback or they're going to see some selling pressure. It's just that the marginal upside is not worth the potential marginal downside that we are witnessing at the moment. Now, going over to the S&P 500's valuation, right now we are trading at just under 4,600. That's where we closed on the day. And if you take a look at the sensitivity grid, and based on the 2023 and 2024 expectations for earnings, if you look at 225, which is going to be Yardini Research and their expectations, and 220 is going to be analyst expectations. And since we closed at just under 4,600 on the S&P 500, the current valuation, and this gives you a little bit of a bird's eye view of the overall market, the current valuation for the S&P is going to be just under 21, which again, if you compare that to historical measures, we are slightly higher compared to our 10, 15, and 25-year averages, but slightly lower compared to our 5-year average. And of course, the earnings yield is sitting at just under 5%. And the treasuries, which is again the shorter end of the curve, especially when you're looking at 6-month, 1 year, 3-month, 1 month bond, fixed income, bonds here in treasuries of the US, then that's obviously yielding you well over 5.5, 5.25%. which on a comparable basis, on a risk-adjusted basis, is far better than the S&P 500. So still a little bit, that attractiveness for equities is still lacking considering the valuations and the bond yields. So as I mentioned before, either the valuations come down to make equities look more attractive, or the bond yields come down to make equities look more attractive. Either way, there's definitely a concept of that opportunity cost that we have to account for moving forward. Now going over to the market, volatility here continues to slide lower. We're still inside this red rectangle. We did see a little bit of a spike here in the last couple days, but then we came right back down to under 13 at the moment for the VIX. And this right here is going to be crude oil that continues to sell off. You can see the lower highs over here for crude, and we continue to get rejected inside this lower highs and this downtrending, sort of like a descending triangle. And support level is going to stay put right here inside this green rectangle between $71 and $73 per barrel for a crude oil. If you do see a breakdown below this, next support really is going to be $65, $66 per barrel for crude. Going over to crypto, so Bitcoin continues to rally forward. We did have a lot of momentum for a lot of these individual companies, like Marathon, for example, was up like 13 or 14%. Coinbase up another 7%. It has had a phenomenal month of November, up 61%, and December starting off with another 7% rally. CleanSpark's up 22%, so very, very strong move to the upside. Riot was up 9.7%, and Bitcoin really is starting to see a lot of momentum, and the next target's going to be 48,000, so another $10,000 for Bitcoin, and that's going to be that next resistance and target to watch for BTC. Now going over to the market, S&P 500, we continue to see some nice momentum higher. So on the day, a very nice green candle, and the next resistance, as we have already talked about, is going to be at 4,600. So on the day, we got tapped out at 4,599. So this right here is going to be that resistance level to watch for S&P going into next week. And support level is going to be at 4,500 all the way down to 44, sub 4,400. Not to mention the RSI MACD, as we've already talked about, overbought and in that rare category at the moment. But December is also, seasonality wise, usually one of the best months for the market. So again, we'll find out what the next 30 days look like. But it's kind of like an interesting dynamic. That's why I'm kind of very curious to learn whether December is green or red, because the markets are overbought on one hand, so technicals are overextended, but December seasonality is very strong. So there's one bull case, one bear case, and it's going to be very interesting to see what ends up playing out. Are we going to see a short-term pullback and then a rally towards the end of the month, or are we going to see a very strong pullback? Are we going to see a very strong rally over the next 3 weeks and then a pullback, given how overbought we are technically going into 2024? So it's gonna be interesting. Like I said, it's hard to make a prediction. Obviously, I'm not here to make a prediction, but the risk reward is what we're here to analyze, and that is not favorable on the long side. I'm still invested. I'm still frequently buying and dollar cost averaging into diversified funds and also individual stocks. But when it comes to trading opportunities, not really looking at anything at the moment. And we'll also be looking at selling calls to take advantage of the higher volatility and, of course, the momentum that we're seeing to the upside, where call premiums are going to be much, much better. Going over to Apple stock here. By the way, NASDAQ is going to, again, have a resistance at 14,400. So that level is going to stay intact, with a support level sitting roughly at just under 14,000, so 13,875 for NASDAQ as well. And of course, this right here is a little bit of a gap that needs to be filled for NASDAQ as well. Talking about Apple, and Apple here also continues to move up very nicely. And this is a potential bull flag formation, which we've talked about in our previous market updates. And if it do get a breakout above this level, next resistance target is going to be just a little bit under 197 for Apple as well. So this right here is going to be that next target and that next resistance level to watch. Support level is going to be a little bit under $190 per share, all the way down to $180 for Apple as well. Talking about Amazon, and Amazon here also moving up very, very nicely. So RSI kind of hanging up there. MACD also just crossing below the signal line, but really just kind of going sideways, going flat. So both of these are really just, trading sideways here. Resistance is going to be at 146, 147, with the support level staying put roughly inside this green rectangle in the 135, 136 range for Amazon. So those right there are going to be some levels to pay attention to, of course. Tesla, I did a video on Tesla earlier, so definitely do check that out. Lots of buyers are stepping in intraday, so down red day, but a green candle definitely does suggest there was a lot of buying activity and a lot of momentum intraday, and resistance is going to be all the way up to $240. So this right here is going to be that level to watch, with a support inside this green rectangle for Tesla, sitting roughly between 200 and 212, $210 per share for Tesla. Talking about NVIDIA, and NVIDIA here on the day also starting to move up a little bit. And you'll notice that we are seeing a very strong support in the low 400s, but a lot of consolidation sideways. It's really been trading in that range for some time, and resistance is going to be staying put right over here inside this red rectangle, and of course support level in the low 400s. Talking about advanced micro devices, and AMD also here getting bought up intraday. Very nice green candle. It is looking pretty weak from a technical perspective, RSI MACD perspective. Support level is going to stay put down to 112 to as low as low 100s, and a resistance all the way up to $130, $131 per share for advanced micro devices as well. Talking a little bit about PayPal here, and PayPal on the day, look at that, 3.5% move to the upside. So very nice move coming up to almost $60. Support level is going to stay put right here at $56, $57 per share. And the next target and next resistance is going to be at $65. So this right here is going to be that next level to watch for PayPal. Talking about Visa, and Visa here continues to move up very nicely. Still slightly down 9 basis points. Not a surprise considering how overbought we are. So the momentum starting to fade a little bit on Visa, but support level is going to stay put down to 250 to as low as $245 per share for Visa as well. Talking a little bit about Meta platforms, and Meta here slightly starting to come down. We are now inside this green rectangle. You can see the RSI, you can see the MACD starting to roll over. It's a very normal, overbought level starting to come down. We're seeing that momentum fade a little bit better. And next support really is going to be inside this green rectangle all the way down to as low as 303. So low 300s to watch for Meta as well. Talking about Netflix, and Netflix here also coming down. So this is a potential short trade idea that I mentioned in my previous market updates. And again, this is what I'm talking about, folks. It's not a question of if, it's a question of when, right? We know it's going to happen. It's just a matter of risk and reward, and the risk reward was very good on the short side for Netflix, and we've got the MACD and the RSI rolling over as well. Same with Meta, same with Google, same with a lot of these companies that are now starting to come down and roll over, considering how overbought the markets have been, overbought these stocks have been as well. So next one is going to be Google, and Google also down on the day, so you can see that we continue to start to come down. MACD crossing below that signal line, RSI also rolling over. Next support really is going to be down to $126, $127 per share, with a very strong resistance right over here inside this red rectangle as well for Google. Microsoft, on the other hand, is also starting to show signs of some weakness here, down about 1%, MACD crossing below the signal line, and we've got the RSI also rolling over. So this is about as clear as it gets, right? We've talked about Netflix, we talked about Google, we talked about Meta, we talked about Microsoft, a lot of them showing signs of some weakness now. I think it's only a matter of time before AMD, NVIDIA, Apple, and Amazon also start showing signs of some weakness and starting to come down, considering how overbought, overextended we really are. And last but not least, we are going to finish off with Costco and Nphase. And Costco here on the day continues to move up 60 basis points higher. I think it did make a new all-time high more recently. Actually, maybe not. $600 is going to be that new all-time high. So that is going to be that resistance level to watch, with a support level inside this green rectangle for Costco. And then finally, we got Nphase, ENPH. Nphase here with a very nice rally. I did pick up more shares at $100. Let's do this. 6% green on the day. So very nice move to the upside. And we're now starting to fill this gap slowly and steadily. And I have no doubt that Nphase long-term, my conviction is strong. And we're gonna come full circle, folks. I'm gonna come back to the videos from a few weeks ago, a few months ago, when people were talking about how Nphase is done, it's dead, and it's the bad pick. We'll come back. Don't you worry. We'll come back. Life comes full circle. Anyway, hope you guys enjoyed this video, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. I appreciate you always. I know there's going to be different opinions and different polarizing views on the markets, and that's what really makes the market. But yeah, thank you so much for your support. I really appreciate it. And make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. The first week of the month is the best time to join if you want to get access to all the alerts. Everything's going to be included. Happy investing. I'll see you all in the next video.